Good morning, everyone, and thank you for joining us. So, as you can see, we are in physical person, which is very exciting for me. I know you guys are still at home, but I'd just like to welcome you virtually into the room. I'm Alicia Harrington-Clark. I'm the head of DC Master Trust and Lifetime Savings here at the PLSA. And I'm pleased to welcome the speakers and yourselves to this event this morning. So CASIS is one of our education partners here at the PLSA, and they have invited a fantastic panel to share some insight on how everyone is using cost transparency to drive governance and decision making. So you'll have to bear with me because as you can see, I apologise in advance for the many different pieces of tech that I have. We're returning to the real world, and so that means that we've got all sorts of different things to look at. So you'll have to bear with me while I look down, then look up. So all of us here are working together on a sort of second year of the Cost Transparency Initiative, and just more generally sort of data collection, data availability, and it's a really big milestone for trustees and scheme managers in the assessment and interpretation of data. So we're hoping that we'll be able to give you sort of a real insight into what's happening, what's working, and what's coming up. So I'm going to go around the table just quickly introducing everyone, but everyone will introduce themselves as well when we sort of start to have a discussion. So don't be alarmed if you don't get much information in this section. So first of all, Scott. Scott is a product specialist of cost transparency at CASIS. Then we have Duncan Wilshire. He's the trustee director at 2020 Trustees. Then Darren Hay, he's head of operations at Brunel. And finally, Venetia Thanawala, and she is head of execution oversight at USS. So I'm not going to do any further preamble. I think we need to start discussing, especially since we're in the room. I think the first thing to sort of start off the discussion really is to talk about this 2 years after CTI. So I'm going to start with Scott, if you wouldn't mind. Has cost transparency been normalised in the industry, would you say? And can you just tell us a little bit about your experience of the sort of normalisation?
Yeah, sure. So hi, everybody. Scott Foster, product specialist at CASIS, very much looking at cost transparency. And we're sort of 2.5 years on from the sort of formation of the CTI group and the CTI templates. And what we're seeing closer to the coalface of cost data collection across a wide range of schemes is sort of pickup of the CTI templates at around 80% of submissions that we're receiving. So there are still quite a few templates that are being received in sort of legacy formats, but the large bulk of cost data that is coming through to us on behalf of pension schemes is in the CTI format, which is great because we're finally collecting data on a like-for-like basis, and that promotes, more standardization and comparability in the marketplace. And so I think that's a really good thing. Another key stat that we've seen closer to the coalface is timeliness of data. So that transmission of data from asset managers to asset owners is sort of picking up. So, asset managers are now coming to terms with what's in the CTI, its sort of breadth and depth of all the data fields within the template. But we are still seeing, I suppose, data quality issues. And I think that's probably one of the key themes to talk about today in, how ambitious the CTI templates are and making sure that the data that does flow through to, the trustees and the board is of high quality and is as accurate as possible before, that feeds into value for member assessments and board reporting and overall assessments of, value for money. Yes.
Thank you very much. Duncan, I don't know whether you wanted to comment on that at all.
Yeah, sure. So Duncan Wilshire, I am a trustee director at 2020 Trustees. In a former life, I was an investment consultant, so advised DB and DC trustees and also sponsors, but now I sit predominantly on DB boards, ranging from very small to very large. And I also have some responsibility for oversight of our sole trustee clients as well. And so for me, I guess, is it normalized? I'd say the idea of cost transparency and using its output is relatively normal, but not common when you look across kind of all the different types of schemes that are out there, which I just think is a massive shame, really, insofar as Scott's just outlined. Actually, the processes are becoming much more slick than they were. Managers are accustomed to it. And my direct experience is actually working with someone like Cassis. Actually, they deal with all of the interaction with the manager. So from the trustee perspective, you actually don't need to get involved in the nitty-gritty. Actually, what you see is the output, and then you start to think about, okay, well, how can we use this output? And I guess when I think about cost transparency, again, with my kind of trustee hat on, I liken trustee boards a bit like a company, a bit like the board of any other business. We've got customers, we've got money flowing in, money flowing out. And it seems preposterous that trustees, that boards don't understand or know how much it costs to run their business. So I'm just really keen now that we've got this momentum to start making sure that more and more boards start to use it.
Thank you. Darren, sounds like a good starter for 10 for you there.
Sure, thanks. I'm Darren Hay. I'm the head of operations with Brunel, who are one of the 8 UK pension pools bringing together LGPS assets. I think, first of all, start off with how the LGPS might incorporate the information field about cost transparency. I think it's very much part and parcel of the core deliverable for LGPS reporting. I think there's been initiatives around transparency codes that have been created through scheme advisory boards. Also, very heavily involved in lobbying and working with CTI working group as well to bring these things through. And I think there is an expectation that managers who work with the LGPS are open and able to provide this type of information. I think where we've seen, my direct experience in the last few years of capturing data, I wouldn't say it's quite standardized in the sense that we see, openness to providing information in different templates, not necessarily always the CTI templates, but what we do see is that there isn't a standardized methodology of actually completing that template. There's often further analysis that needs to be done, further breakdown, and it can become quite onerous. So I again agree with Duncan in terms of the concept is very much, certainly from the LGPS perspective, core. But I think there is still some way to go to having a standardized practice in the market. And I do agree, in a previous life, I worked with Zurich as within their propositional team, and also worked very closely in trying to build out cost transparency and also general transparency information for DC schemes. And I think there is quite a big difference between some of the larger firms, smaller funds as well, larger funds, in the ability to actually get this information out of certain managers in certain areas. And I say it is a shame, certainly for the LGPS and for Brunel, it's absolutely core. We won't work with managers who won't provide this information.
Thank you. So Venetia, over to you.
Thank you. So I'm head of execution oversight at USS. Given the size of our scheme and the complexity of the asset classes we deal with, it's been a long road for us. Second year into it now. I just kind of break this question into 2 parts. I think the data collation part is becoming normalized. We had a heavy lift working with Scott to create a data pool for our internally managed assets, but also to educate external managers in completing the CTI templates, especially our US managers, I think, who are less familiar with this kind of standardization. This year we were hoping it would be a bit better. There are more templates coming back as CTIs, but there's still a heavy lift and education piece that needs to happen. We've also now told managers that we won't work with them unless they sign, an agreement to provide the cost transparency data in their IMAs. So that's an improvement. And then on the flip side, it's is there normalization in terms of interpreting the data you're collecting? I think we're at the very early stage here. Our board were somewhat confused, quite rightly, because we presented them with cost transparency data, and then they also get presented with value for money assessments, and they're not the same thing. So I think we'll turn to this shortly with the TPR's recent publications. But But I think that's an early part there. How do we integrate what we're presenting to our boards, not just cost data, and what cost data, what do we consider costs? We have private markets investments, so there are lots of carry accruals, performance fees. Is that really a cost that we want to control? That the flip side of that is performance. So we need to integrate that, but then also scheme management and governance. So it's a bigger picture. So I think it's early days. I think it's too soon to say that cost transparency is normalized for us.
Thank you.
I think sort of leading on from that as well, it naturally leads into how you take this information forward. I think one of the big things that we've wrestled with is very much the layer of performance in terms of value. So is that cost worthwhile?
Yeah.
It's all kind of well and good and understanding that maybe a cost versus a benchmark is slightly out, but actually, are you getting what you want from that for the cost, if you like? And there is that kind of layer of almost strategy context that needs to be brought into it to make sure that the information is therefore discernible for a board or trustees or anyone who's looking at it, clients, etc. And it is quite a challenge. It's quite a time-consuming and differentiated piece of work because no one strategy is seemingly the same. So, it's an interesting one how we take that forward.
I think it's really interesting. It's really topical because the TPR recently came out with its sort of DC consultation around value for money, and the question they're trying to pose is: should we standardize the way value for money is sort of assessed? Should we standardize the metrics? Should we standardize the benchmarks and standardize the output so that savers can look at a sort of value for money report for one scheme relative to another and assess, okay, that one looks better, I'll choose that. So that's probably a question, to the group here. Is standardization of metrics, benchmarks, and reports something that would help, do you think?
I'd say yes, in the first instance. I think getting something out there and then refining it makes sense. I know that, in DC world and anything that's kind of published and regulation, obviously it's sometimes difficult, that refinement piece, and what you end up with something that is not perfect for a long period of time before it gets refined. Yeah. But I think as an industry, actually just getting that mark in the sand, that line in the sand, and then using that, but then also kind of innovating and thinking about all the other things that we can do and the other reasonable metrics to put it against, I think would make sense. So I'm supportive. I don't know about you.
Yeah, I agree. I think, as you said quite rightly, standardization in terms of getting something out there. I think what we found at Brunel is that often you need to be quite unique in terms of the benchmarking. I think particularly when you're talking about pension funds and their asset allocations, there isn't generally a standard fit. It is very much defined dependent on, whether you're looking TBDC, whatever the outcome may be. So I think standardization was helpful, to have something to work with, but ultimately the holy grail is to have the ability to almost nuance that to your asset allocation and understand your benchmarks down to actually what you're investing in, making sure they're kind of signing through. But it's quite a step and quite a leap, and it probably, it would only come with a certain amount of time of capturing data.
Yeah.
So very much a future piece.
Yeah.
Did you the same thing, really? I think absolutely having standardized templates has helped us start collating the data, and then it throws up questions. Is that template correct? Are those fields really the right ones we want to be looking at? And so that continual refinement, as you mentioned too. And I think it's too soon to, again, start benchmarking. The asset class mixes vary by different funds. With different schemes, it's too soon. And if our board of trustees, are struggling with what we're presenting them with, how do we expect savers to understand it? So we're definitely not there yet. In my opinion.
And to add to it, I think it may vary widely as well in terms of scale, size of scheme. So, starting points that actually kind of put you in a ballpark of comparable schemes and benchmarks are useful. I think sometimes the blanket standardization can muddy the water somewhat, so to speak, especially when it's a particular board they want to know about their scheme particularly, and that they are seeing the right level of information. So there is a very fine line, I think, in walking that, providing standardized information that you can feel comfortable and stand behind it.
Yeah, I was going to ask a similar question actually after your sort of the first answers there threw up so many different things that I want to ask about. So audience, please remember that you can ask questions in the chat as well, because otherwise this will become just me picking at random questions that have occurred to me. So please do remember to ask questions in the chat. But one of the things I was going to ask about was the benefits and drawbacks of standardization. So you mentioned there the sort of the bespoking and the need for bespoking in performance, but also in costs. And so I just wondered, is there a danger of a bit of tick box approach sneaking in here when we start to talk about value for money or member assessments more generally, obviously sort of theoretically, but also literally on the ground? I don't know if anyone has any comments on that, but I just feel that there might be a bit of a tension there.
Yeah, I agree. I think if we, push the regulator to make this a requirement for DB schemes too, that won't really achieve what we're setting out to do. I think if we try to take a step back and think, what are we trying to do with this? Maybe, a head of an asset class does want to look at the, equities mandates and see how he can control those costs. That's useful information, I think, and it can help actually drive business decisions. I think it's, it's a false sense of security to think we're ticking a box and starting to publish our CTI templates. It's also a false sense of security just saying, oh, well, we've given these numbers to our board, the job done.
Absolutely.
I guess I have a slightly different view, which is just that I think if you recognize that it is today very difficult to benchmark, very difficult to compare, and some of that is just because the universe that is available in terms of comparison is not massive. It's not the full universe. So you're always making assumptions through that, and sometimes you might be comparing two funds, or a fund versus a universe of funds that is imperfect, and you have to make some assumptions. But I think just having that information is very important. And if I think about it from a trustee's perspective, there's never going to be a head of equity on the trustee board who's going to go and really look at this. But what the board does want to know is get a sense of, actually, is there anything that doesn't look right here? Just even if it's the flags, it's not have we optimized every single line? It's just, actually, is there something we fundamentally didn't realize? Or are we spending way more on LDI than the 2 basis points we thought we were paying the manager or whatever else? It's kind of getting that understanding, which I think is incredibly useful. And certainly my experience is we're then able to push back on managers and say, this isn't within what we were expecting. Can you talk us through that? And sometimes they say, oh, okay, well, there's something not quite right here. And sometimes they say, yeah, that's just the way it is. And trustees say, okay. And that's kind of part of their education. So that's why I guess I'm happy accepting it's imperfect, because I think there's a greater good to all of this. And the more people we sign up, then all of a sudden we can start creating a much better universe for comparison.
I think the box ticking point, I mean, obviously with if it's made mandatory across the board, I think there may be some of that creeping with certain individual funds managers, etc., because there will be a requirement and they'll have to get something over the line. I think, very much, as you said, Duncan, I think there's different groups want to see different outcomes and different information. I think a base level that is appropriate to, what you're looking for is where you start. But obviously the ideal and the outcome really that the CTI and the working group are looking for is for us to take that information and actually do something with it. So very much with Brunel, it's part and parcel of our oversight program. So with our managers, making sure that we're not paying too much, and that actually the transaction costs, for example, that are coming through are proportionate with what we expect and how we expect the mandate to run. But then also it's useful for a board level or a trustee level to see overall where your total cost of ownership sits and how much it actually costs to run your business, essentially. From an investment perspective. So there is almost these kind of dual strands coming from it, and it's not only becoming about, certainly for Brunel and the LGPS world, about ticking the box. and the obligation. It's about utilising that information to your day-to-day business running, but also to bring insight. And we're very much thinking along the lines of making more disclosures. Thinking about how we use that information and make it publicly available for all the members of all of our schemes, not just necessarily the committee and any of their consultants or anything like that. So, that's I guess where it was all going from. But I can see tick box exercise creeping in. I mean, surely.
I think it's difficult for us as well, but we're obviously very actively participating in the cost transparency initiative. So we're very biased. We're like, of course, we're going to present everything we can collect, and we're going to, collate as much information as we can and analyze it and use it for business decisions. It's interesting to hear your perspective from actually maybe a regulatory requirement would be helpful, because you maybe, and Scott, you too, in terms of onboarding new clients. I'm sure there are plenty of people out there who are reluctant to take part because they don't have the internal resourcing. It's not a strategic priority at the moment. Right. So it's interesting to hear from your perspective. Maybe there doesn't need to be more of a stick incentive. The carrots work for us, but maybe it doesn't for others.
And I think one sort of barrier to entry that we've seen with some schemes is, because benchmarking and things like that is imperfect, and because there are maybe data quality issues, I just won't start looking into it. I don't want to open that Pandora's box. But, from what I've heard just now and with the clients that we work with on cost transparency, the first sort of year is actually a look at yourself. It's an internal look. What does our scheme look like from a CTI cost transparency perspective? What do all these numbers mean? How do we integrate that and think about that more in the future? So I think there's always an urge to go for benchmarking, compare yourselves to others and look at all that sort of external stuff. But in the first year or two, maybe even 3, it's really an internal review of, okay, what does that mean for me? What does that mean for my scheme? And how do we create an action plan for the next, few years? And so I think, that's really interesting.
So benchmarks are only important because you want to be able to assess whether what you're looking at is good or bad. And actually, for trustee boards, sitting there and there's a number that says our costs are £7 million, and it's like, okay, well, should that be 5 or could it be 10? I have no idea. And that's the only reason that people immediately kind of look for benchmarks or comparators or something like that. I think Scott's point's absolutely right. It should instigate that internal look of, is this kind of what we were expecting? Is this what we thought we were signing up to? Let's talk to our managers and explore that and understand that. And then take it from there. And I think the benchmark is an evolution of that. The other thing I will just say to your point about kind of the level of involvement, certainly when you spoke in that opening part about, being at the coalface and some of the complexities around getting data and everything else, actually as a trustee, I feel insulated from that. So I have people who do that for me. So I have no, it's not a constraint on my governance capability or decision-making frameworks or anything like that. Actually, the thing just gets presented to me. People like Scott are scrabbling around and pulling their hair out and everything else, for obviously, which we're appreciative of. But actually, I just haven't had that experience at all.
That is fascinating. Can I ask you a question there for all of you actually about behaviours and attitudes? Because I think all of your experiences will be slightly different on this, both internal, whatever that means in your context, behaviours and attitudes towards sort of transparency, but also with other parties, so service providers, asset managers, investment consultants, whomever that you might be engaging with on cost transparency advisors. What's your experience of behaviours? Has that and attitudes, has that changed over time? You mentioned actually earlier sort of LGPS code. Do you feel that things have changed behaviourally since then? I'm just interested in sort of trends almost.
Yeah, I mean, I think naturally the market generally has changed in terms of its focus on conduct. I think that's obviously been a big driver from the FCA. So, when it actually bring it down to cost transparency, the LGPS transparency code is very much in line with what the CTI working group and work is trying to do. But again, with the pooling initiatives, one of the big strands of pooling was to allow a governance platform that wasn't necessarily able to be in place before because of differing funds not working kind of together or having a scale. So I think naturally all of those things within sort of my world, if you like, has led to, if you kind of don't step on the wagon, so to speak, you're going to get left behind. So I certainly can see it from my angle that all of those things work together to actually really open people's eyes and sort of think more about what's the right thing, what is the outcome we want to get, rather than just thinking commercially or thinking, it's going to cost too much to do something here, as a manager or whatever it may be. But that's, I suppose, within the LGS world, that's fairly contained, in terms of its regulators and bodies. It'd be interesting to hear, and certainly I can hark back to my experience in a kind of a DC environment, a more non-government backed entity, right at the start of this whole journey, and obviously it was met with some skepticism. It was met with a kind of a thought that it wouldn't catch on. This will never work. So I think we've come an awful long way from that, and that's fairly short time in terms of kind of 5 to 7 years really. So it's quite remarkable, I think, from my point of view.
Scott, I don't know if you want to.
And all relatively on a sort of maybe voluntary basis. The CTI isn't a sort of regulatory template. It's not a mandated template. It's still sort of voluntary, and people are starting to walk to the beat of the CTI drum, if you will, in regards to actually using it, picking it up. I think back in the days, maybe 4 years ago, you send a data request out, you get a rude response or just be blanked completely. But these days now it's like there's sort of more structured teams that will deal with that request, and a more structured process in the sort of investment management world to sort of pull that data out of various systems and populate it into a template that makes sense to end users and asset owners. So I think that for sure. And I think cost transparency is just one piece of just transparency as a whole. And I think that's probably an overarching theme that we've sort of seen from in the likes of the FCA and the TPR, very much a focus on a strategic priority on transparency of data across the board, not just costs, but everything else. And then weaving that in sort of governance around that data as well, being a key theme. So yeah, I think things have evolved probably for the better, and transparency is more sort of normalized. I don't get those angry emails anymore. Let's put it that way.
Generally across the board, again, you kind of look at the FCA's views, and you look at kind of things like the Woodford cases, and you think about the recent kind of consultations around the AFM-HD market and assessments of value. It's very kind of focused, and I think the UK particularly has come leaps and bounds. I think the US is still an area that's developing, but certainly Europe, UK, it's kind of, it has become much more accepted. As Scott says, there's no what's that anymore. It's very much kind of oh yeah, I understand, and we'll get on it. That's certainly what I've seen as well.
What about from a trustee perspective and a sort of governance perspective? Do you feel that people's attitudes have changed towards transparency in general?
Yeah, so I guess there are just so many stakeholders from where we sit. To Scott's point, this having been voluntary up until now, if you look at the board itself, the board's reaction, they've kind of gone into this willingly most of the time, or at least someone saying this is a really good idea, should we do it? And everyone says, well, yes. And so their reaction to it tends to be positive. So seeing the output, but then also just okay, well, what do we do with this now? Is the common response. Certainly from a kind of sponsor's perspective, the sense that they can start to see some value for money for the contributions that they're putting into a scheme is helpful. So they're generally pretty engaged. At the asset manager level, again, I'm somewhat insulated from that up until the point that we need to go talk to them about something that's been identified. But my sense is that there's greater engagement, and I think, yeah, depending on the mandate, they can be a little bit more shy and what have you, and potentially if they've got something that they'd rather people don't know about, they can be a little bit more shy. But overall, I think it's kind of going in the right direction. And then I guess investment consultants are the other one, who probably look more shocked than trustees sometimes, just because they, the trustee is saying, we thought this was a 10 basis point fund, and then it's showing up as like 80, what's going on? And so investment consultants can sometimes have some awkward conversations as well. I've never seen an investment consultant stop it. And actually, there are a bunch out there who are very keen to engage on the topic. But yeah, it can be a bit awkward. I think the other point is, from the trustee perspective, we're also looking at costs across the board. So we're trying to incorporate how much are we paying our investment consultant, our actuary, our administrator, kind of all of our service advisors, and putting that alongside each other. So yeah, varying reactions, but I'd say on the whole, all positive, and everybody's aligned to where we're trying to get to, which is better outcomes for members.
Fantastic.
If I may ask a question, from your perspective as a trustee, I mean, how often when there is something that comes up, it is quite technical, and does that kind of cause problems for the trustee or the board, in terms of they may want to know the technical aspects, or there may be kind of a knowledge gap, if you like, in terms of, depending on the trustees and the boards, obviously. How often does that come up, and what's your opinion?
So it's invariably going to be board specific. Clearly, if you have a board with an investment background or whatever else, they're going to be all over this, and you'd say that there's very little kind of knowledge gap. On some other boards, yeah, I mean, there's a huge gap between what they could know and whatever else, and actually they're just looking at everything on face value, and so then they're relying on either whoever's put that report together, or the investment consultant, or me if I'm in the room, to try address some of the things that don't quite look right. But at that point, that is usually them going to another service provider to explore it, rather than to say, okay, well, now we're going to go into the weeds on this point. Again, so as an investment consultant, I was always of the opinion, why are people not spending more time on this thing? What I'm saying is really important. Listen to me, please. But actually, becoming a trustee, you just see that the breadth of things that we talk about is like this wide, and some of this, however important it is to us, it is just a sliver in the set of things, which is why invariably, most trustee boards are just going to have to rely on providers and advisors to help them through this. But getting the information is critical. Getting it on the piece of paper is paramount.
The ecosystem is critical, as you say. The ecosystem to provide it and analyze that information becomes critical, particularly in those situations. It's Venetia's probably in a similar position. It's what I spend a lot of my time, and my team will do, is looking to try and address those technical gaps, so that in a way that is communicatable, if that's even a word. It's probably not, but so that it can actually be consumed. And that is where we at the coalface, you spend a lot of time trying to dissect and then communicate out. So that's obviously where service providers like Scott and others come in and are very useful.
Can I ask a question, actually, maybe of you two particularly, about, you've mentioned sort of consumption, but also action as a result of information. And I feel like one of the questions we've had through is about whether cost transparency could aid trustees considering climate change risk. So I'm just sort of interested in, there's the consumption of the information, then there's the action as a result of the information, and we've all sort of danced around it a little bit, and I think sort of Duncan started taking us on the journey of, okay, so what do we all do about this? So I'm just interested in reflections on action as a result of the information. What have all of you seen, but particularly from your perspective, maybe what's going on internally as a result.
I think the actions on our side have mostly been driven in making sure our data is more accurate, data cleaning throughout the year, rather than waiting till February, post year end, March, to try to understand what went wrong, relying on other service providers to provide us accurate data. If you're waiting a year to correct data sets, it's too late. They can't backfill all the information that you need. So I would say we've focused there. It's been too soon to try to take business action off the back of this. If anything, it's been working with external managers to make sure that they know up front that we're going to want this information, making sure with portfolio managers too, who manage our mandates, that these are the things we're looking at, FYI, for your mandates. And we're going to be reporting this. So if you start getting questions, don't be surprised. This is the data that I'm presenting. So you need to be happy with it. But it's been too soon to make decisions about, okay, well, we're going to try to reduce our external manager fees by 10% this year or something. None of that yet.
Yeah, I'd echo the point around it's very much been about oversight of external mandates so far, very much. I think Scott nailed it earlier by saying it's a bit of internal look. It's, have we set up the strategy and is it performing and costing what we expected? I think to talk about the climate change risk, thinking it through, I can't quite grasp in my mind how cost transparency and the CTI template as it currently stands could really help with that. I think, very much climate change. There are better data metrics out there now than there ever have been, but it's still very much, an evolving place. And I think it's very separate to that cost transparency mechanism. I think in the future, certainly one of the things that we're thinking about is, where we have created more climate change centric strategies or funds, is that coming at a cost, and is that cost worth it? That's the kind of thing where cost transparency would be very useful to bring out whether you're getting value from those climate change centric strategies, as well as are they actually achieving the climate change metrics and points that you wanted them to achieve. So I think I'd be interested in what you want to say there, Duncan, but I'd struggle to see how trustees would get much from a climate change perspective from CTI.
Yeah, so I was trying to think it through. I guess that last point might feed into it, which is some of the climate, well, a lot of the climate change momentum is off the back of you getting better risk-adjusted returns, better managing risk and better risk-adjusted returns. Lots of funds will slap green on the front of it and charge an extra 10 basis points or whatever it might be. So it might be that it's a way to potentially see through some of those things. The other way I was just trying to think was whether what people do around kind of carbon offsetting or something like that might feed through into some of the kind of private debt stuff. But I think that might, I don't think this is a natural home for that. So I'm not quite sure. I think if whoever wrote the question wants to give us a bit more of a feel, please do. But yeah, I'm not sure otherwise, other than assessing, is this green fund actually giving us better risk-adjusted returns?
Sorry, I think it just makes that point again. The cost transparency information in its own right is very much a building block, I think, to further business decision making. There are other strands that have to be brought in before we can really action things, and it does need to be done over, in my opinion, over a number of years to be useful. It's very hard to make a decision off the back of 1 year, 2 years, even set of data. But from a climate change perspective, it's there may be some conversion, but there are so many differing bits of information out there that are probably more applicable for climate change than probably cost.
Yeah, I wonder, so part of the sort of, I didn't give the full question because it sort of went on to talk about the context of TCFD reporting. So I was just wondering, Scott, you might have a comment on that, the connection in with other, not just TCFD, to be honest, probably, but other governance style reporting. I guess there is a connection.
I think the parallels that could be made would be around the standardization of templates and how data is shared from like service providers, asset managers to asset owners. So just like how we've created a sort of CTI template for cost transparency, does there need to be a standardized TCFD template for accounting for climate change risks? And I think the Investment Association is looking into that to help, I guess, standardize the way in which data is flowing from one side to the other, and doing that as sort of efficiently and on a like-for-like basis as possible. So I think there is a sort of working group on that. And the rest is sort of behavioral. So again, it's okay, now you've got a standardized template, let's say for TCFD, scope 1, 2, and 3 carbon emissions data. How does that then flow through into the boardroom, and how do we make decisions off the back of it? And that whole process is, what we're going through at the minute for cost transparency. So the parallels around data and governance leading through to action are the sort of parallels
exactly
that I can probably draw without stretching too far on that for sure. And I think we've been talking a lot about slicing up cost transparency data, and it just got my mind going in relation to what's again in this sort of DC consultation, a suggestion in that consultation to say, okay, if we're looking at CTI data, do we split it up into fixed ongoing charges and then sort of variable costs? And maybe trustees and that sort of board level can look at those fixed ongoing charges and maybe work on that, potentially try and negotiate them down, whilst those variable costs go up and down as year over year and depending on market conditions. So that's one way of slicing it up. And another thing that we've seen is slicing it up by sort of asset class, so picking up broader asset classes, and then potentially even sub-asset classes if you're so inclined to look at specific LDI costs or emerging market equity costs or whatever it is. So you can start to sort of zoom in on a specific topic, because I appreciate you sort of looking at the whole CTI template as a whole across all the various mandates that you're invested in. It can sort of be a wave of data that's quite sort of overwhelming, but those sort of small things that you can sort of zoom into might help that journey. And as things, as CTI data and cost transparency data becomes more and more normalized and just a part of the discussion, then you can maybe start looking at some of those technical things if you wanted to, once that sort of overall consciousness around cost is elevated.
I was going to add to the I was sort of thinking along similar lines to you in terms of the sort of overall flow of information. And one of the things that the PLSA has looked at is a TCFD reporting structure, it's quite dissimilar actually in a lot of ways to CTI reporting for many various reasons, but there is a sort of, I can see the sort of connection there in extremis and in the sort of end goal. So it's quite an interesting idea. And I think the connection with value for money assessments potentially coming through in a more standardized metrics-based benchmark type way, scorecards and that sort of thing might lead us there. I think the other thing that we've all sort of mentioned here, but again haven't talked about a lot, is data quality. I'm sort of loath to ask the question because I sort of know what the answer is going to be, but data quality, what's it like?
It's getting better.
Good.
I would say as an education piece, internally and externally, I would say it's improving. So I think it would help. We've obviously been on this journey for a couple of years now. It would help to have more guidance on things. The same questions came up this year on anti-dilution offsets, for example. What do you do with less liquid instruments where you don't have arrival price data? How do you clean your data up for placements and IPOs and things like that as well? So I think in the first instance, we're trying to get our own house in order, looking in the mirror, as Scott mentioned earlier, making sure that we're doing things on a consistent basis where possible across asset classes and within asset classes year on year, getting there.
I think it's worth drawing out as well, there is a fairly significant difference between what we define as listed markets and then private markets. I think the private markets is still on a journey. It's getting there, it's improving, as you say, but generally, they're slightly further behind in terms of their infrastructure if you're working with external managers, and obviously internally it's a whole different ecosystem that you have to adapt to and work around to get the information out. So I think very much listed markets seem to be kind of getting there, and the data quality, whilst there are still some nuances in simple things like including things that have gone through the NAV that haven't necessarily, or they should be in a different category, and you're getting into the real weeds there. But that's kind of the level you're at with listed markets. I think with private markets, you're still working through which template will we get and how will we get it, and so on and so forth. So just a kind of difference in that will probably close over time.
I guess what I wouldn't want the sense of complexity, and not to downplay that in any way. And again, I'm hands off, so I can't say. But what I'd hate for anyone to take away from this is that there is complexity which would stop them from doing this. Because actually, I think if we're trying to engage as many pension schemes as possible to do this, actually, most pension schemes, to your point, are going to be investing in a large indexation manager, some equities, some bonds, and some LDI, right? And then when you get a bit bigger, you might be stepping into a few different sets of kind of private markets, but with established managers that kind of everybody knows and whatever else. So absolutely, as you get bigger and bigger and bigger and more complex, I can absolutely see how it just becomes an absolute nightmare with anti-dilution levies and all those sorts of fun things you're talking about. But yeah, for the vast majority of people, it will be less of an issue. Now, Scott can probably say, actually, it's an issue, and we're fighting those fires for you. But again, I haven't seen or experienced that.
It's the point is made well. I think, it's not to put anyone off. I think it is now developed to a point where actually most managers can engage, and actually the quality of data can be trusted. I think that's what I was trying to get across. If you're not in the private markets world, there are the data quality is getting better there. So it's getting to a similar point. So the time is kind of now. If smaller schemes engaging a few years ago, it would have been much more difficult. And obviously, people like Scott and Cassis and other companies, are very useful and clued up with that. So, it's now a much more doable piece of work than it ever has been. I'd agree with that.
I think, overall engagement and demands for this data has promoted and prompted behavioral change to share this data onto asset owners. But a question that I like to think about a lot is the data quality sloppiness potentially due to a lack of codification of rules and a sort of mandated responsibility of the asset managers or service providers to pass that data on to asset owners on a precise date, for that data to then feed into some sort of overarching regulatory reporting system. I'm thinking a bit about how things are sort of done in the Netherlands with cost transparency. They started their journey in 2011, and they're now in a place where it's a standardized regulatory report that feeds through to the regulator every year. They have a wide universe of the whole Dutch pension market, and they've got all that data that they can mine and share insights on. And so when looking at an asset manager's regulatory reporting priorities, if they've got a MiFID II template that they have to send by a specific date versus a CTI template that is just being asked for by little old me, that isn't necessarily a regulatory responsibility. It's a sort of best endeavors approach, goodwill sort of approach. In some instances, not all. Is that the reason why? Do we need to mandate the CTI across the board to make it more formalized and set in stone in the industry? I think that's always a question, and maybe we'll get there in the future, but I think maybe the CTI itself is still evolving. There's still, work going into the template. It's not in its final form. There are iterations going into it. So maybe we're still on that journey. Going back to the Dutch example, it took 4 years for it to become a regulatory requirement. So they created their version of the CTI template in 2011, played with it for 4 years. In 2015, regulatory requirement. And the industry, on a sort of voluntary basis, helped create that final form. So maybe we're still sort of halfway through that journey, 2 and a bit years in. Those would be my thoughts. Yeah.
We've had a question actually, which coincidentally and conveniently, we've almost answered most of it, because it was about whether CTI should be mandated or optional. I know we've all, I think, spoken about that earlier and now just returned to it very neatly. So I'll ask you the second half of the question, which is some nuance on that. Do you see different answers for DC, where the saver foots the bill for costs, versus DB, where ultimately the sponsor foots the bill? It's an interesting question, isn't it? I think it's a good question.
Yeah. On the ground, the way in which asset managers respond to data requests for DB or DC is quite similar, to be fair, I think. But that might be due to the nature of the clients that we work with and the sort of buying power that they have. That's probably,
In our experience, I think DC had a head start because they had an extra year of DCPT, so they were a little bit more ready. We tend to be more in pooled funds in DC, so that just makes it a bit easier as well. It's standardized. It was a bit easier, but I think that DB's swiftly catching up.
I mean, from a Brunel perspective, it's all DB. So I can probably speak impartially. It doesn't come into the thought process really. It's more about the end investor. So from a DC perspective, it's all about getting as much and the best outcome, and that might actually be in some cases a slightly more expensive fund or expensive setup, but as long as that's delivering what the end consumer wants and needs, then so be it.
Yeah, and I guess so. The sponsor foots the bill, yes, but it is still for the benefit of members, and there is the risk that sponsor's not there forever. So I don't. Yeah, it's not obvious to me that you would separate out the two. I think we either think it's a good thing or not, and then take it from there. But yeah, I'd be inclined to certainly encourage everybody to do it. And the other thing is, I think, as someone suggested, it tends to be lots of the same managers who your DC providers often provide for DB as well. So actually they wouldn't necessarily be doing anything fundamentally different.
Can I ask about providers, since you mentioned providers? So open question. What do we think that providers could do more of, or less of, maybe, indeed, to facilitate and help with the sort of more general cost transparency agenda? Are there things that we would ask of providers?
Who do you mean by providers in that instance?
So I mean in the loosest sense, but particularly asset managers, but any intermediary as well.
Yeah, so asset managers are not necessarily incentivized to do this, right? They may well say that they're working for the benefit of members and all that sort of stuff, which is not untrue, but they're not incentivized to do it. It doesn't necessarily benefit them, I would guess. There might be instances where they can point to, they are more transparent than the market or whatever it might be. So some kind of marketing aspect, but on the whole, kind of not. I think actually the advisors, and they have a large part to play in this, especially those who recommend the managers that ultimately are used within a structure. So I think they have a massive part to play, and it's in their interest as well, because they are incentivized to do it. If they can demonstrate lower cost, they can demonstrate the value that they're adding to that individual client. So I think there's a big part for them to play.
I think there's also a part for us to play. So we talked about this earlier, but we've been fairly militant, Brunel, in terms of saying unless you will sign up to this and provide this information and work with us, we won't work with you. And you know, with anyone from the early days who isn't quite on that bandwagon has been brought very much up onto that bandwagon. So you know, that kind of industry lobbying, if you like, you know, is quite powerful and makes waves within the asset manager fraternity. So, you know, very much we're behind it and see it as a strategically viable point for those asset managers. So, you know, by making that action, if you like, making those comments, it's trying to drum up the ones who aren't quite on that curve to lead. But obviously, it comes back to a commercial decision sometimes, you know, for those asset managers. So, you know, you would want them to be putting the outcomes first, as you say, and being able to demonstrate actually, so they can win further business in the future, that they are competing in this area, not being left behind. I think that's another key point to add. But I agree, you know, what Duncan said. I think you know, there is only so much you can ask for. I think, and a lot of it would need to be driven by the ecosystem around, particularly also the end consumer.
So we can definitely help ourselves, certainly as trustees, by just when signing up to a new manager, when doing a new fiduciary management agreement, whatever it might be, just making sure there's some reference in there somewhere to the provision of data. And even if you're not taking that data today, actually that is starting to apply a little bit of pressure for zero cost to you, to that manager, to start incorporating this into their processes.
Absolutely.
I'm very sorry we've run out of time, but that feels like a perfect time to finish, actually, with a sort of pitch for engagement. I'm going to ask you a brief question in a second, so be prepared for it. I'm going to say, does the Cost Transparency Initiative work so far? So be prepared with a short answer, but I'm just going to thank the audience for participation. We've had some really interesting questions through, and you know, thank you guys for taking so much, sort of providing so many thoughtful responses to these questions, because they are quite searching. So quickly, Cost Transparency Initiative, has it worked so far? Scott, if you could start.
It has definitely helped my life being a bit easier. It has certainly helped the transmission of data from asset managers to asset owners. But as with anything, it's still a sort of work in progress. There are things that we need to sort of iron out, but it certainly helped the industry from an overall governance and transparency perspective, for sure.
Fantastic. Okay.
It's not flawless, but absolutely yes.
Fantastic. That's a great quick answer, Darren.
Yes, been very useful, allowed us to live and breathe our principles. But as Scott said, you know, there's more to do.
Fantastic, Manisha.
Yeah, echoing what they said, it's put us on the right journey, I think, to ask some very important questions.
Thank you. Thank you so much. Thank you so much to all of you. Thank you again to the audience. Just a quick reminder that this session will be available online, and you can watch it, rewatch it, and share it with anyone that you feel might benefit from hearing this just really fascinating discussion. Just also a reminder that we have our annual conference coming up, which will come really quickly upon us because it's on the 12th to the 14th of October. Take a look at the website for more information. There are sort of similar topics to this, but not quite the same, I have to say. But there's also another CACEIS session, so I thought I'd just mention that, because it's about climate risk, so it's very conveniently sort of associated with some of the discussion today. Thank you so much for your time, for your participation. Thank you also, audience, for your time and participation. And from all of us here, thank you. We'll see you next time, hopefully in person. But until then, enjoy the most of your rest of your day.